Hi friends, have you ever wondered why few people in stock market makes 5% returns, why some people make 50% returns? For this, a fund manager called Lee Freeman Shore from UK conducted a research on 45 fund managers who were managing funds of the tune of more than $20 million. And he established that the success in stock market is dependent on how you execute. It's all about execution. Very much similar to in real estate market where location is what really matters. In stock market, what really matters is execution. What I mean by execution here is when to sell, when to buy, and when to do nothing. For example, right now Nifty is at all-time high 19,000 and people don't know what to do. And what is causing this rally? So there are four macroeconomic factors that can decide a lot in terms of your success in stock market, and you can make huge money if you understand these four macroeconomic factors. Throughout this video, I will explain you the concepts of these four economic factors and their impact on Indian stock market. And I'm going to take practical examples throughout this video. Please do not skip the video. With that, let's get this video started. The first macroeconomic factor is US Fed rate. Let me show you with data that how US Fed rate impacts Indian stock market and the opportunity it presents for us to make a lot of money. Have a look at my screen and you will see that this is the US Fed rate from roughly January 2022, and you will notice that until February 2022 it was going flat, and all of a sudden, let us say from March, in fact from April 2022, the Fed rate started to increase from 0.33 to almost, if we come to July month, July 22, this is the sharpest or steepest increase in the Fed rate. As a result of this, what happened in Indian market? Let me show you with some data. Have a look here and you will see this is the Nifty 50 chart, and you will see that until April 2022, the stock market in India was going up nicely. But the moment from April 2022, the Fed rate started to increase at a very high speed. You will see until July, what happened to Indian market is that from April 2022 until July 2022, the Indian stock market started falling badly. Have a look at here. Nifty was roughly 18,000 at that time and it fell to roughly 15,000. That is a lot of movement in Nifty within the 3 to 4 months. And people who knew this concept, they started to buy more and more mutual funds, stocks, and started to build their portfolio because that was the right time to make good money. Now the natural question, Rahul, how would I come to know about the Fed rate? Extremely important. Have a look at my screen and you will see something called as FOMC meetings. So these are the Federal Open Market Committee meetings that happens mandatorily 8 times every year. And what you will notice here is that just immediately after the meeting, next day, Indian stock market reacts very sharply. It might be positive reaction, it might be negative reaction depending on what is actually announced in that meeting. Each and every word that is spoken in that meeting has a lot of weightage. So for example, if you look at this data, you will see that around January, February, March, May, June, July, you will see how Nifty has reacted. You see June 14 to 15 into 2022, after that meeting, Indian market crashed by almost 2.11%, and that is huge. If you have 10 lakh rupees of portfolio in Indian market, and that means 2% of that means roughly 20,000 rupees, meaning you are losing the portfolio that very day by 20,000 rupees. It may mean that you might want to go and invest more money because you know it's a temporary drop in the market and you can earn up to 2% very easily in very short term time period. So as a pro tip, please keep an eye on FOMC meetings. The dates are announced by US. Please Google them and you will find out every year. And depending on the reaction on the Indian stock market, there is a good opportunity for you to make money. Now the obvious question, Rahul, what is the relation between US Fed rate and Indian market, and why when US Fed rate goes up, Indian market comes down? Let me explain to you, but before that, very quickly, it is not 100% correlation that whenever the US Fed rate will go up, the Indian market will fall down. Nothing is 100% here, but more or less the chances are that when the US Fed rates goes up, Indian market falls. Now let me very quickly in 20 seconds explain to you the logic of why this happens. So let me take you back to January 2021. What you will see on my screen is US inflation rate, and you will see that US inflation rate was at around 1.3, 1.2 at that time. And all of a sudden after COVID, what happened was US inflation rate started to increase very sharply, and you will see that by the end of July 2022, it was almost touching at 9%. This is extremely high inflation rate in US, and for this to be controlled, what US government does is what US Fed does is they increase the Fed rate. So you will see that from a data that from April 2022, what they started to do is increase the Fed rate. So what is Fed rate and how does it control inflation? Very quickly, US Fed rate simply means this is the interest rate at which banks in US lend money to each other. And if this rate is very high, then what will happen is the overall borrowing in the market or in the economy will start to drop. As a result, the inflation will start to fall back to its normal levels, right? And when this happens, the side effect of increasing the Fed rate will be that bonds in US becomes more and more lucrative because the bonds interest rate also goes high. Therefore, they start to give you better yields or better returns. So if a fund manager or an institution need to put money, what they will do is in these circumstances, they will start to put the money in bonds. They will start to pull the money out of the equity or the stock market and they will start to put the money in bonds because bonds will start to give them higher returns because of the higher interest rate or higher Fed rate. As a result, the money is pulled out of the equity market from US and as well as from Indian stock market. Therefore, what will happen is when FIIs are pulling the money out of Indian stock market, Indian market will start to fall. So this is the overall concept of when the US Fed rate goes high, the Indian stock market starts to fall down. The second very important macro factor is US dollar index. Let me show you very quickly. Have a look at my screen and you will see that in the last 1 month, US dollar index has dropped almost from 102 level to almost 99 level. And as a result, what you see in Nifty 50 is in the last 1 month, Nifty has gone up from 1800, 600 levels to almost 1900, 500 levels. Now, I'm not saying entirely this is because of the US dollar index, but there is a strong correlation between US dollar index and Nifty market. So if the US index dollar decreases, then the Indian market goes up. And why this happens? This happens because when the US dollar index drops, it simply means that US dollars as a currency is losing its value in a short term. What that really means is FIIs in US start to pull the money out of US market and they might be investing in lucrative markets such as Indian market. And let me show you the data here as well. So if you look at the FII data in the month of July, you will see that FIIs did gross purchase of 94,000 crores and their net sales were only 82,000 crores, meaning there were more money that was put into Indian stock market by the tune of 11,000 crores. And that is why Indian Nifty has soared like anything in last 1 month. Point is simple. If you know how to track US dollar index, you can find strong correlations between US dollar index and Nifty market, and that itself presents us huge opportunity to make money in terms of buying, selling or doing nothing. So far, if you're finding this video educating and if you're learning something new, hit the like button, share it with your friends and let me know in the comments so that I continue to make such videos as well. So far in this video, I've been talking about the impact of US economy on Indian stock market. Now comes the macroeconomic factor number 3, which is Indian inflation and how does that impact Indian stock market. For that, have a look at my screen and you will see that in July 2022, Indian inflation was becoming at around 7%, extremely high. And after that, it started slowly come down. And now in May 2023, the inflation is coming back to its normal levels in India, which is around 4 to 5%. Now, whenever Indian inflation rate is extremely high, what really happens is that RBI will start to increase the RBI repo rate. What is RBI repo rate? Let me quickly show you here. You will see that from April 2022 onwards, RBI has been increasing the repo rate consistently and it is right now at 6.5%. RBI repo rate simply means the interest rate at which RBI lends money to the banks. Now, RBI raises this repo rate to control the inflation. What really happens is when the inflation is extremely high, people have a lot of money, economy has surplus money, and what RBI does is increases the repo rate. When the repo rate is increased, what is likely to happen? People will not be able to borrow money. Companies will not be able to borrow money. They will not be able to spend money. They will not be able to invest in the stock market. Therefore, you will see more selling happening in the Indian stock market rather than more buying. So, Indian stock will fall down. Indian market will fall down. Let me show you this manifestation in the Nifty results as well. So if you go back to Nifty chart, you will see that back in April 2022, Nifty was at around 18,000 level and until May 2023, Nifty has been at 18,000 level only. So the market has been extremely flat. It has not moved at all because the RBI rate was extremely high. And therefore, what we can understand from inflation is if there is a high inflation going on in the market, then RBI repo rate is going to be high and the stock market is not going to give you a lot of return, But please understand that this is a strong correlation. It may happen, it may not happen. It may happen 7 times out of 10. It may not happen in 3 times out of 10. The fourth extremely important macroeconomic factor that I want to explain to you is the prices of crude oil and how it impacts Indian market and the opportunity it presents us to make some money. So have a look at my screen and you will see that whenever the prices of crude oil goes up, Indian market falls down in the short term. So this is all short term. So short term here means if you look at a month horizon, right? What you will see is that May 2000, May 2008, March 2022, there has been a strong correlation whenever the prices of crude oil, for example, here they went up by 3.1%, here 14.8% and here 23%. And you see the orange bar here, which is presenting Nifty. It is showing a negative correlation, minus 0.5, minus 0.5, minus 0.7. It simply means negative correlation simply means that the Indian market will fall because the prices have gone up. Likewise, what will happen here is in July 2008, January 2015, there is again a very strong correlation, meaning that if the prices of crude oil fell down by almost 16.9% or 4.5%, Indian market went up. And this is where the opportunity presents itself, that if we know that crude oil prices are going up, then Nifty is going to fall. We need to take some positions in buying either an index or any stock that is going to follow the fall. And the main reason why this happens is because whenever the crude oil prices go up, investors start to think that the supply chain cost or the logistic cost is going to go up for the companies because the fuel prices is going to go higher, and as a result what will happen is the profits that companies are going to make is going to be slightly less, and therefore the stock prices are likely to fall. It all happens as a psychology or a fear, and it may not even materialize in the profits of the companies because we are only talking about the short term impact of the crude oil prices onto the Indian stock market. I hope you understood these 4 very important macroeconomic factors and you are going to practically implement into your stock market execution so that you can make a lot of money using stock market. Now a humble request, please let me know in the comments if you like this video or not, because that is the only way I know whether you are enjoying such videos or not, and should I continue or stop making such videos. Let me know in the comments please. I will see you in my next video. Until then, keep rocking.